Hello, welcome back. This is Roger Royce, host of the 10,000 Startups podcast. I'm a partner with Haynes Boone in Palo Alto, California. I do emerging growth and venture capital. And Haynes Boone is a Texas law firm. And today we're going back to Texas to talk to Shan. He's the founding partner of iFly VC, which is, I guess, a few years ago relocated to Austin, Texas. Thanks for being here, Han, to talk to us about the venture capital market. Normally our program is very focused on startup law issues, but today we're going to turn our focus a little bit away from legal issues and more towards market issues. Because, like I say, I do emerging growth and venture capital, and pretty much every client I have is venture backed or wants to be venture backed. So your words are gold. Um, so let's just maybe start off with as I said, you're the founding partner of iFly VC. You're also on the board of a company named We. You're a Kaufman Fellow, and you were previously a partner at Formation 8, which I understand has also moved to Austin, or at least has an office there. So, on with that introduction, maybe you could just kind of kick it off and tell us a little bit. Before we get into the market, tell us a little bit more about what iFly does, what stage, sector, what you look for in terms of your investments.
Yeah, so definitely. Roger, thank you for having me. I was browsing my CRM and recognize our initial meeting slash interaction can be traced back to January 2013. Just how amazing, this shared journey has led to a lot of interesting conversations. Definitely appreciate what you contribute to the community and or referral of, contacts, friends, allies. Definitely appreciate what you have done. Just a little bit about iFly. The firm started in 2016. I'm the founding partner. Before that, I spent about 7 years working at other firms, Vantage Point, Formation 8. Moved my way from associate to partner. And 2016, from that point to now, the past 8 years, iFly is all about an investment thesis that makes American consumers happy. We are excited about the consumer economy. It's not only huge, but also it's not static. Now, there are different consumer drivers, such as the change of generation, the shift from Gen X, Gen Y, Gen Z. Every shift creates opportunities. There's also cross-cultural influence in the American market. I'm Chinese, I'm Asian, so I witnessed firsthand how some of the Asian elements start playing more and more interesting role in how the youngsters consume. Imagine all the matcha flavored beverage, K-pop's rise and popularity among non-Asians, boba tea as another example, and also the migration of population from states to state net is also going to shift a lot of consumption from different states to the mover's destination. At the same time, I'm also excited about the technology enablement. As an investor, also with my background with a PhD science engineering, I'm always excited about tech. But in the consumer space, you don't have to invent everything starting from scratch. I love the tech-savvy founders who know how to build tools in-house or know how to assess the way to source third-party tools off the shelf with the primary goal to drive efficiency from production to marketing, sales, and operation fulfillment, right? So the combination of tech enablement and the consumer insight is where we look for opportunities. So at iFly, we don't make a lot of investment every year. The average is about 2 to 4, 4 being the maximum number of investment we have done. That's only because we want to follow our conviction based on a lot of research. There are so many industries we have followed, studied, learned. If we didn't see the conviction or if it didn't feel the right fit with the startup, we want to respectfully, pass on it, but still try to, be helpful whenever we can, such as introducing to other VCs or friends who can help with biz dev or partnership. But if we do have a strong conviction, we are happy to lead. We are certainly okay to follow another lead. And in quite a few cases, we were so bullish that we just became the only investor of that round following the conviction. The stage of the investment goes from pre-seed to Series A. Our check size so far has been between $500,000 and $5 million. Yeah, so that's how we invest and operate. Oh, last but not least, let me just also add a point. Now, given the concentrate portfolio and I would say we have no trouble answering a founder's call at 11:30 p.m. We are proud of being the first one called by these founders in our portfolio. When they need us, not only we have the motivation, but also the bandwidth to get involved, helping founders getting to the next level.
Gotcha. So let me ask. So your pre-seed to Series A, 500,000 to 5 million. Let's say at the lower end at 500,000, what do you expect to see from a company? Do they have to have revenue? Do they have to have EBITDA? Do they have to have year-over-year revenue? Or do they have to have traction at all?
Yeah, great question. So if it's that early, pre-product launch, pre-revenue, obviously we'll put a lot more weight on the founder's quality, right? Well, when I refer to founder's quality, it doesn't necessarily mean the founder had to get like incredible academic pedigree, credentials, or coming out of these like famous tech companies, right? To us that helps, but it's not everything. So we care a lot about what incredible insights the founders carry so that they can really see something that's not obvious to others. And also, what is their core strength that will allow them to follow a strategy to stand out of the crowd. The consumer space, on the one hand, may look, easier for everyone to penetrate. On the other side, just given our experience, to do it well, to do it in a profitable and scalable fashion is actually never easy. Right? So we really look at some of these non-quantitative attributes of founders if we write a check at such early stage. Of course, if it's a seed or Series A, as a company has done more work in terms of proof of product market fit or getting real numbers, that's the other side of the equation where we will also take into account.
Okay, gotcha. And at the higher end, 5 million, at that point, I expect you want to see a whole lot more market traction.
That's right. But there are also two pieces of it, right? On the one hand, every investor will probably talk about tracking the metrics, the numbers. On the other side, even with revenue traction, we want to make sure not only we recognize the metrics or the numbers and data point, we also want to understand truly the drivers behind it, right? For example, let's take um, a customer survey as an example. NPS is a popular term used by a lot of startups, but we care a lot more beneath the layer of the NPS, right? What really takes the customers, what people really like or dislike. And also, we don't stay at the service level of what customers say. I'll give you one example. One of our best performing companies about 6 years ago, as we went through the due diligence, uh, by the way, the name is called WEE. They serve Asian and ethnic minority groceries online and deliver it to your household for free if you hit a minimum order value. So almost 6 years ago, as we went through the due diligence, at the time, of course, they had a substantial revenue. But guess what? The customer survey came back with very lousy comments, right? I mean, the comments are not lousy, but the comments are about the company being lousy. And I was so curious. I talked to almost 20 customers directly in person or over the phone. And of course, they knew I was an investor. So they asked, oh, are you thinking about investing? Oh, really? Don't invest. I'm like, why not? Right? Because when over almost 20 customers told you don't invest, you better listen. So I asked, why not? And the consistent comment was, oh, yeah, it must be a second-class team in Silicon Valley. I said, okay, what made you feel this is a second-class team? And again, the consistent answer was, oh, look at the UI UX. I mean, it's definitely so bad. It's not the Silicon Valley typical kind of a quality for UI UX.
Yeah.
Not only was amused slash interested, but actually, I became even more motivated after I heard these seemingly negative comments.
Mhm.
The rationale behind that, logic was that with such lousy UI UX, you guys still purchase on a weekly basis, right? So to me, that means the company we 6 years ago already solved the core problem, which
Mhm.
is telling you what you really need, right?
Mhm.
Everything else, obviously, for a startup, nothing is, not everything is perfect. But everything like US certainly can be fixed and improved later on when they had more resource, right? So obviously, this is one of the many reasons we found our conviction in investing in that company, even though the particular round they got turned down by everybody else. But the point I'm trying to make is even with real revenue traction, with real like metrics to follow, I still want to, as a team, we still want to emphasize on uncovering these non-obvious factors as we make a decision on investing or not.
Yeah, well, I think you made a good one. Like I said, I'm a customer of We. It's
Oh,
the only
thank you.
place I found that'll deliver bitter melon to my door. So, so what do you know?
Appreciate business.
Yeah. So tell me more about that. That's great. You found that opportunity and you saw that. But speaking more generally, what's the market look like right now here in 2024? We all know 2023 was really a terrible down market. What's 2024 look like?
I mean,
And
2024.
2025. Yeah.
Yeah, yeah. From my perspective, the market, whether it's private or public, early stage or late stage, it's never homogeneous, right? So obviously there are still hot pockets, especially AI. Even today, well, it kind of cooled down a little bit, but there are still companies in the AI space that raise money seemingly without any much issue, right? On the other side, I constantly, have to bring this up that the best investment is often happening when the opportunity is still not obvious yet to most others, right? So the fun part and the hard part of investing is seeking and seizing the non-obviousness in the landscape. And this thought is applicable, I believe, to both private and public market. If everybody loves Nvidia or Tesla, that's the price of the stock you pay for. Whereas at the same time, if someone actually recognized the potential of NVIDIA or Tesla way before everybody else, you have a chance to capture the alpha of the investment return curve, right? Otherwise, you probably best shot is go after beta. So for me, I'm almost agnostic to what's quote unquote hot out there. I'm almost agnostic to what most other people talk about.
Mhm.
We at iFly really focus on what's the essential driver for the change and who will be able to drive that change. And also keep that in mind that early stage investing to us means we'll have to go through cycles, right? Or the exit path to, excuse me, the average exit path will take usually, 5 to 7 years if you're lucky. Sometimes takes even longer than 10 years. So that means that you're almost guaranteed to live through some cycles. And that also feed into our equation when we assess early stage opportunities. Just that means it has to really, really make sense. It has to withstand the test regardless of the macro change. That's how we think about our investment philosophy.
Okay, gotcha. Shifting gears a little bit, you moved to Austin a few years back. I mean, I'm still here in Palo Alto, so I pay ridiculously high state income
Welcome to
taxes,
visit.
but I get to go hiking in Half Moon Bay on weekends. So I guess that's the trade-off. But tell me, what's it like being in Austin as opposed to Silicon Valley? Are you still finding good deal flow? Is there a startup community? Is it a good place for a startup or an investor to be?
Well, yeah, great question. Like I said, you're welcome to visit Austin or Texas anytime since you guys have office here. Yeah, so when I moved to Silicon Valley in 2009, it was after a lot of painful kind of job hunting experience during the post 2008 financial crisis. I just graduated from business school at Wharton with the MBA. So getting into Silicon Valley, getting a job in VC was something I felt very proud of for a long, long time, I felt, gosh, and this is the center of the universe. I would never see myself leave, period. Right. But then over time, I recognized things were changing, right? The change was primarily about where the startups had popped up. from NorCal to SoCal to East Coast, New York, Miami, Boston, Texas, the cities like Salt Lake and Atlanta also produce a lot of unicorns, right? You think about what caused such a change and the rise of the new startup ecosystem, is those cities have all kinds of advantage attracting talents, whether it's cost of living or different kind of policy toward business, right? So there's a bucket of them. But the impact is that once you have these big companies moving to different hubs, let's just say 1% of their employees are smart enough and restless to create something new. Those are the seeds of new startups. And in fact, Texas has also produced so many startups that reach this unicorn status. And Atlanta and Salt Lake, for a while, I never imagined, just like most other Silicon Valley-based investors, that these regions could also produce unicorn. Of course, I felt my face hurt, after a while, realizing how short-sighted I was. But the flip side is, as an investor back then in Silicon Valley before COVID, one of my biggest logistic puzzle was, gosh, I saw this interesting opportunities referred to me, by friends in New York or Miami or Texas. Should I be serious about it? Can I really make a trip to those cities to talk to the founders in person? And what about the adverse selection issue, right? So for a while, I felt challenged. But then, 6 months into COVID, I had my aha moment in October 2020 that, oh, we should just decant and move to Austin, Texas to have a new home base. So to iFly and to me as a GP, this relocation is driven by the business needs. We wanted to have a new hub in Austin, and the local ecosystem for startup and investor has been booming and continue to boom since we moved here. And beyond that, the central location of Austin makes it much easier for me to travel to the East Coast, Miami, New York, or Midwest, and equally convenient back to California. So it gave me the chance to make a lot of these short trips, like 2 days, one night. I can accomplish a lot of in-person meetings whenever I need to fly. Or the rest of the time, I still have in-person meetings in Austin or do Zoom back to back like today. And 3.5 years ago, we made the move. And so far, I felt this is one of the best decisions that I have made.
Wow.
Um,
No kidding. That's yeah, interesting. So the last thing I want to ask you about is it seems that AI is everywhere now. We just did our annual agriculture technology conference about a week ago, 2 weeks ago, and of course that was the dominant topic of conversation. I'm sitting on a panel today on AI and oncology. It's just everywhere, and it seems to be changing everything. I guess I'd like to get your view on this. How big a deal is this? Are AI companies overvalued? Is it an overheated space? Is it overhyped? Or is this really as good as people think it's going to be?
yeah, so excellent question. We are all living through this kind of interesting time period, right? So a lot of other speakers probably already touched on different sides of the AI phenomenon. But what I wanted to say is, we are still probably at the tail end of the initial phase of overheated AI kind of buzz, right? At this point, as more and more people recognize the opportunities and challenges facing both AI investors and the startups, it gives us a chance for us to learn from that initial phase. Meaning, for example, what's the real product market fit? We really have to pause often to think hard about those questions for both founders and investors. So instead of falling into the trap of a typical kind of early phase of technology adoption cycle, learning from other people's success and mistakes. But the market is still huge, adopt all kinds of AI-enabled tools. And again, whether a founder wants to develop an AI-based tool starting from scratch, or at the same time, those founders who are tech savvy or even AI savvy, understanding what it takes to select the proper AI tool to manage their own business. I see a lot of exciting opportunities in that regard. In my investment practice, I also wanted to emphasize sometimes people underappreciate the ownership of the distribution. What I mean by that, for example, a very glamorous business, let's say a restaurant, right? Now, there are a gazillion startups trying to develop a SaaS tool with AI or not, going after the restaurant space. Back of the house efficiency improvement. Of course, it sounds very attractive, but it takes a lot of effort to sell. And then each license value might be worth just $1,000. But let's also look at the restaurant business itself. A restaurant with an average revenue per year, say $1 million with even just 10% margin, right? That's $100,000. Now, how many SaaS license does it take to sell to create that kind of a revenue or even profit, right? So obviously the valuation metrics are different, but I want to point out is what if this restaurant that already make a lot of net profit can even do a better job by adopting the proper AI tool, right? So that can give a very different kind of equation for the future landscape of the tech-enabled restaurant scene. As the generational shift is happening, it's not just about the consumers, but also about the founders, right? So what I feel excited about is there are these unglamorous industries where the generational change of founders and operators will also cause a lot of disruption and upgrade of the business. That's also something I feel, excited about potentially making investment.
Gotcha. Okay, well, I want to thank you. We're coming to the end of our time here at the bottom of the hour. Thanks for being here, Han. This is Roger Royce at the 10,000 Startups Podcast. We've been talking with Han Shan. He is the founder of iFly VC, an Austin, Texas-based venture capital firm operating in the technology space. So thanks again, Han, and we'll see you all next week.